All right, good morning. Today is the 6th of August, and I want to welcome you to this session that I'll be holding for most probably the next 3 months. And it is just an additional mentorship to what we already have. And if you're still new, these sessions might also be helpful. However, it is mostly for intermediate traders, people who already know the basics about trading. Now, what I really have to say, first of all, is that these sessions that I'll be holding for the next 3 months is just basically to help people who already know the concept of supply and demand. And it's majorly for the people that have been mentoring, and these sessions are mostly going to be ones which will help them to master now what they call subjective trading. What trading majorly entails, one, we have what they call mechanical trading, and then followed by what they call subjective trading. Subjective trading, this is now where you're going to apply different market concepts. And then lastly is what they call intuitive. This is whereby you have now attained full mastery of the concept. Now, let me use this. Yes. When you've already attained full mastery of the concept. And mostly when I'm mentoring students, I teach them what they call mechanical trading. This helps a trader, first of all, to be already profitable. And they can be profitable if they're able to follow a system of rules. One thing that students need to realize, or if you're beginning to trade or learn how to trade, is to know that you need to, first of all, teach yourself to obey a set of rules. And once you're able to learn how to obey a certain set of rules, that is where you are going to be able to, first of all, see that trading is basically the ability to set for yourself a certain give yourself a certain set of rules, and then you're able to follow them religiously. That is where the money is made. Now, for this particularly, is now going on to subjective trading, and of which this is going to be now for intermediate traders. Intuitive trading now comes as a result of mastery, whereby if you're able to come to the charts, you're just going to be able to know what you need to do next without really having to think so much about it. Now, mostly what I do teach is what they call supply and demand. I do teach supply and demand trading. And supply and demand basically deals with what they call orders in the market. If, for example, you have a market that is maybe moving on to the uptrend in such a manner. Now, what basically happens when a market is moving to the upside? Sometimes this is what happens. A market leaves what they call unfilled orders. And the unfilled orders is, in most cases, what we do, wait for to enter our trades. And in this case right about here, we have, for an uptrend, a market forms what they call a demand zone. And the reverse is true for the formation of a supply zone. Now, what you would aim to do is, of course, when the market comes to this zone of yours, most cases it has to be a higher time frame, 4 hour and above. Some people, yes, can even use 1 hour and below. However, the most effective for people who are beginning to learn how to trade, you should always aim for the higher time frame, the 4 hour, the daily, or even the weekly, depending on the kind of person that you are. Now, for this case here, when the market comes down to the 4-hour demand zone, you would wait for price to first of all come and then tap on this zone and then continue to the upside. You would set your order right about this point. Your stop loss would be somewhere around the lows, and then most probably you would be targeting for the next highs, or based on your profit taking strategy, you would either maybe set a certain risk to reward ratio that you feel you are comfortable with. Now, what I'm now going to be doing for the next 3 months, teaching subjective trading, is now applying the different concepts that you need to learn, first of all, to make sure that at least you're trading not just mechanically, but you need to know at least what could have happened when you see something happen. Now, what I will be now incorporating into what I'll be discussing for the next 3 months is what they call, yes, market structure, but the market structure is going to be based on the concept of smart money concepts. Smart money concept. Now, market structure is actually something that once you learn from the very beginning of your trading, it will help you to better your trade. Some professional traders, they say, once you simply master the concept of market structure alone, it is going to help you to not only at least improve your win rate. However, if you don't first of all take time to master market structure, it's going to be a little harder for you to see profitability in this game. Now, one of the concepts that I went ahead to research and found was very key to beginners, and it's much more easier for beginners to master, is the concept of smart money concepts when it comes to explaining market structure. Now, with smart money concepts, there are just very simple things that you need to understand, the key terms that you be hearing time and time again. Now, the key concepts you need to know about is, you need to know about what they call break of structure, break of structure, break of structure, and then we have market structure shift, market structure shift, or market structure shift, or what they call the change of character. I'm now going to put in short form, change of character. And then you also need to be knowing about what they call imbalances, or what they call fair value gaps. Fair value gaps. Fair value gaps. I think for all my students, this is what we call it. We call it imbalances. Imbalances. We call them imbalances. And then there is also the concept of liquidity. Liquidity. There is also the concept of liquidity. However, in this mentorship that I'll be discussing, the concept of liquidity seems a little bit more confusing. However, I'm going to explain it so that you are able to learn. Liquidity is, simple terms, is where they say most people put their stop losses or their pending orders. So in most cases, the market always seeks for two key things: the imbalances and liquidity. Now, in understanding these terms that you're going to be hearing quite more often, you need to understand the basic market structure, which I think almost every beginner learns at the beginning of their trading. They tell you that the market, of course, moves in three basic ways. That is, okay, a market is either trending, you need to know this, or the market is either ranging. This is what you need to know. And when the market is trending, it can either be trending to the upside, like in this case, forming what they call a series of higher highs, and then you also be having what they call higher lows, right about here, higher lows. Now, a market only forms these two when it is moving to the upside. A market forms a series of higher highs and a series of higher highs and higher lows when it is trending to the upside. And when the market is trending to the downside, what basically happens is, let me delete this and then just draw a new one afresh. The market is moving to the downside, forming what they call a series of higher lows and lower lows. It is forming, let me take this. Let me take this. Just write a new one. It's forming what they call higher lows and then another series of lower lows here. Lower lows. So you need to know these things. And also you need to know this. All right. So a market in an uptrend, it will be forming a series of higher highs and then higher lows. However, for the case of a downtrend, is higher lows and then lower lows. You need to know these basic concepts at the beginning of your trading. Now, once you know this, what about the ranging markets? Now, for the ranging markets, what basically happens is that the market will just be moving within a certain range, one of a kind. It is neither forming higher highs, nothing of the kind. So, excuse me for that. What basically happens, it's just going to be moving within a certain range of a kind. And this market can only be traded after what they call a breakout. These markets can only be traded with what they call breakout. Now, you need to know these concepts at the very beginning of your trading. Once you know this, now you can start moving to other concepts of the market. Now incorporating other strategies that are going to be necessary. Now, the basic concepts of smart money, or what I call, let me now call it smart money concepts. It's going to be understanding market structure in depth. When you have a market that is moving to the uptrend like this, like this, like this, like this, I'm going to add on from there to avoid confusion. A market basically is doing what they call, first of all, you need to know this move to the downside is called a retracement, and then this move to the upside is called an impulsive move. And when a market is moving to the upside, what you need to know that a market has to be breaking these higher highs and then creating new higher highs. So for it to first of all break this higher high that has already been formed, this is what they call a break of structure. It's what they call a break of structure, abbreviated as BOS in this case here. It will just continuously be breaking lows higher highs that have already been formed. Now, of course, nothing goes up forever. You need to know this. Nothing goes up forever. If a market has been creating a series of higher highs and higher lows, it is trending. However, you need to also know that the market will at times, what they call it is do a reversal. Now, when a market reverses, of course, there is going to be what they call shift in the market structure. And the ability to identify this is very important. You need to know this. Let me call this. This is what I term as a bearish market structure. However, it is still the same concept. You can call this a change of character or market structure shift. And now in this case here, the break of structure that is going to be happening is going to be to the downside, where the market is now forming a series of higher lows and then lower lows. You need to know these concepts early. Now, once you're able to identify this, of course, it comes with practice. What would now need to happen for you to enter into a trade? What would need to happen is you need to learn how to enter early on these retracements or at the beginning of an impulsive move. Once you're able to do that, then at least you are going to find yourself making these good decisions, what they call these subjective decisions, to know when to enter into a market. And once you're able to know the concepts that SMC basically entitles, you are going to be making much more smarter decisions. Now, with this kind of strategy of SMC, incorporating SMC into your trading, you're going to be able to learn that at least your trading is going to be, the win rate is going to at least increase. Now, this system alone works, yes, but you need to be able to first of all incorporate other disciplines. Know the right time to be trading. You need to know at least how much you're going to be risking on each and every trade. Once you're able to identify some of these things, you're going to be able to execute better trades, and then at least you're going to see some better results in your trading. Now, you need to know that every other system works depending on what you're comfortable with learning. Some other people, yes, may be comfortable with using ICT concepts. Others, they just use supply and demand. Everything comes down to the person that you are. But now you need to know that what each and every trader at least knows from the very beginning is what makes the market is just understanding the market structure. Every strategy that doesn't incorporate market structure is not literally trading, as long as they're using technical analysis, yes. Some people use what they call fundamentals, but executing these trades require you to have a basic understanding of at least technical analysis. Now, this is just the basic introduction of this series that we have begun. And in the next video, I'm going to be analyzing some trades based on this concept. So you can watch this. After watching this one, make sure you also watch the next one to see how I'm going to execute, or I'm going to analyze a trade today based on what I've already discussed with you here. Otherwise, without further ado, please make sure that you stay tuned and watch all these videos. They are not going to be very long because they are for the purpose of learning, and I know the attention span of majority of people can't be very long when you're trying to learn new concepts. Now, without further ado, these videos will also be on Telegram and on my YouTube channel, just for the sake of making other people also learn. Without further ado, so if you're on YouTube, make sure you subscribe. And then if you're also a returning subscriber, make sure you like the video so that I keep on making educational content like this. Otherwise, peace out.